Yeah, you're like.
Good evening, ladies and gentlemen. Myself, Kavit Shaw, on behalf of HDFC Securities, welcome each one of you for today's session on an interactive uh, webinar with our esteemed speaker, Mr. Dipen Sheth, on investment mantra for 2017. I welcome our esteemed speaker for the webinar and would like him to take over for the webinar. Thank you, Dipen.
Thanks, Kavit. My name is Dipen Sheth and I head the institutional research function for HDFC Securities. We would like to make this webinar as interactive as possible. So I'll just make some opening comments, share my thoughts on the markets with you, and we'll take it from there. We already have a number of questions which have come in from investors, and we'll take as many of them as possible during the course of this webinar. So, in my opening remarks, I would just like to make some very limited points, but I think they're of immense use and significance as the year 2017 unfolds in front of us. We at the institutional desk, the research desk, we believe that Indian markets are on a mixed course for at least the short term, which means the next 3 to 6 months. And we believe that therein lies an opportunity to make diligent and patient decisions for the subsequent period. And in many ways, this is exactly what good investing is all about, that you don't get caught up in the momentum, whether it's on the downside or the upside. We've seen a lot of retail investors getting dragged or swept into bull markets and then waiting on the sidelines for a while and then entering it and creating tops. Similarly, now that markets are in a little bit of a drift mode, particularly post demonetization, we think that the post demonetization crack, if one can call it that, and uncertainty in India's near-term growth trajectory affords patient investors the opportunity to diligently invest in equities for the long term, first of all. Second, we do also believe that the recently rising crude prices pose at least some kind of a mild macro threat to India, and this is going to keep markets a little subdued and yet again giving more opportunities to make diligent decisions for investing. Third, I think there are policy evolution risks arising out of increasing friction in Parliament. For example, we've been bullish on GST implementation, and now the friction in Parliament is going to perhaps lead to a postponement of GST adoption. We also believe that there are policy risks arising out of Trump's victory in the US. We believe that there is global political uncertainty arising out of belligerence exhibited by China, and of course the troubled Middle East and the exit of Britain from the European Union. However, we also think that solid opportunities are beckoning investors towards India. So, and the reasons, the opportunities are being created by these factors. One, a decidedly downward interest rate trajectory. So there is an inflationary impact, of course, of rising oil prices and the strong dollar. But overall, I think India has already started seeing significant softening in interest rates, and this will only continue in the future. Second, post demonetization and a whole lot of other initiatives taken already by government and some more which we expect will be taken. We expect to see much better tax compliance and increased economic activity in the organized sector in India. Now, this is going to lead to tremendous opportunities selectively for Indian companies who have to grapple with unfair competition from the organized sector. From the unorganized sector, sorry. So listed companies in the organized sector who are facing this competition are very well set over the next 2, 3, 4, 5 years to capitalize on these opportunities as the unorganized sector takes a backseat as a result of better tax compliance, as a result of better GST, as a result of GST rollout, and as a result of demonetization. Third, we think that the real prospect of seeing fiscal incentives in the upcoming budget, which is going to happen on the 1st of February this time. So these fiscal incentives are likely to be centered around what we call the Bharat economy as well as the infrastructure economy, whether it is social infrastructure or hard or physical infrastructure. We suspect that the Modi government will attempt to revive a softening economic trajectory as it prepares for the last 2 budgets in its eventful regime. And finally, we believe that there are some positive surprises in line for several globally exposed companies listed in India. outside of the India story, of course. So, for example, we think that pharma companies will ride a wave of increasing genericization in the United States as healthcare costs come under pressure there. We also believe that despite the near-term headwinds and the demand challenges, several Indian IT companies will put their cash chests to use for acquiring interesting new companies, smaller companies in the IT space, and thereby acquire competitive edges. So this is a rough overview of where we think we are headed. The big picture message obviously remains that yes, we do believe India is going to be in a little bit of a drift right now, but the long-term drivers for investing in India are absolutely valid, and in fact they will give you a 3 to 6 month opportunity as 2017 unfolds to make several long-term investment decisions. That, can I now open up the webinar for questions?
Thank you, Dipen. We have already a list of questions ready for you.
Right.
So the first question that we have a lot of investors asking is demonetization likely to derail the Indian growth story?
Yeah, so there's been such a lot of noise on demonetization, and so many opinions have come around on it, both positive, negative, or even neutral, I should say, on it, that I think the noise around demonetization has probably reached a level which is higher than the actual impact of demonetization. Of course, there is pain in the economy. Of course, people have been put to inconvenience. I cannot deny that at all. However, please keep in mind that demonetization is a little bit like chemotherapy. Let us understand that there was a very clear cancer in the economic system, if we can call it that. Yes, the entire body has to take the brunt of chemotherapy. Now, that cancer is actually a mix of poor tax compliance, endemic corruption at multiple levels of government machinery, and I would say, poor organization of Indian businesses, whether small or big, which were centered around the cash economy. There are some parts of the economy which will never shift out of cash, and that is understood. They are taking some pain right now. But over a period of time, the shift to digital cash, not just banking cash in the form of check or the electronic clearing system, the shift to digital cash has a tremendously positive impact in terms of money multiplier and the economic velocity in the financial system. And as more and more people get pulled into, even compulsorily, and sometimes a little painfully, into the financial system, I think demonetization has such superb long-term impacts. One in terms of tax compliance, two in terms of the monetary velocity within the financial system, three in terms of making credit available to those sections which were outside of the banking system. That I believe that over a period of time now, whether it's going to be 3 months or 12 months, well, I think the economists should figure that out. And a lot of them are, I must confess, not talking things that make a lot of sense to us. But having said that, I do believe, yes, there is short-term pain, but there is very, very solid and sustainable long-term gain on the economy. So if demonetization has actually derailed stock markets for a bit, and I can see several financial sector stocks, for example, down at 20-30% from their recent highs. Well, actually, this is God's way of saying that I'm giving you another chance to invest and get onto the buses that you had missed.
Or probably it is. Something which is a little related to it. People also would like to know what would be the effect of this event on the dollar-rupee relations.
So I do not believe that the dollar-rupee dynamics are impacted by demonetization in a way that we can logically link cause and effect. Let's be very clear there. I think today the dollar is at a very, very strong level compared to 2 or 3 years ago for a variety of reasons. One being that the US economy has been surprisingly resilient, and unemployment has fallen there. We now have a very aggressive leader who is going to take charge in January and who is going to spend and create a lot of infrastructure in the US and kickstart that economy back to the 2 to 3% kind of growth rate. It's surprising that when large parts of the world like Europe and Japan have actually shown recessionary trends, the US economy has actually grown at anywhere between 0.5 to 2.5% over most quarters in the recent past, and which is why I believe there is monetary tightening also on the cards. So at the last FOMC or Fed meeting, I think the writing is very clearly on the wall that we should be seeing maybe about 2 rounds of tightening in Fed rates over 2017. So the dollar is going to remain strong, and you don't really need to have demonetization for me to give you a view on the dollar there, and which is why that is one of the reasons why we are reasonably bullish on pharma and IT companies. Valuations, of course, in IT companies are down to I think 4 or 5 year lows right now. So it's a very interesting situation.
Right, Dipen. So the next question that we have is, does falling interest rates imply that bond funds and can deliver good returns versus the equity funds?
Yeah, so this is a very interesting question again, because the temptation to invest in bond funds as when you see a falling interest rate trajectory is very high. I completely take the point that bond funds will make reasonable money. In fact, bond funds have been some of the best performing funds over the last year or two. And which is why the recency effect is taking its toll, and people are saying that our investors are feeling that perhaps they should be investing in bond funds. I do believe that bond funds will give reasonably good returns, but you must keep in mind that much or at least part of the fall in interest rates has already been captured. So today you have the 10-year bond at least 130, 140 bips lower versus a year and a half ago or something. And in fact, even post demonetization, I think there's been a 40-50 bip drop. So some of the gains, I won't say most of the gains, are already in the game. Right. And I think the way to invest in mutual funds here on should be to take a reasonable mix depending on your risk appetite between bond and equity funds. There isn't a one size fit all answer here, I'm sorry. I'm afraid people will have to take their own calls. For those who are longer term in terms of orientation, I think a slightly heavier equity tilt is not is certainly called for, and they shouldn't shy away from that. Make sure that you will that you will be happy to accept low single digit returns for maybe up to a year, but this is actually the time to stock up on equities.
So we have a lot of customers also asking on whether this is the right time to be in the market or move away, shy away from the market. Or should we keep on adding more at this point in time? So
Kavit, the old truths on equity are now visible all over again, if you ask me. So if you want to make money in a month, should you be in equities, then I think you should park all your money into fixed deposits in banks or in bonds, and you will surely make money every month. But is that the kind of money that you really want to make? And especially when yields are falling and most banks are also revising down their FD rates for, let's say, 1 year deposits, they're now down to 7% or below with most banks, right? So if that's the kind of return you're happy with, surely you should be staying away from equities. But I think most of our investors, most of our clients and customers of HDFC Securities are really not that kind of people. So if you have that at least a mild risk appetite, then this is, like I said, the time to stock up on equities. Do not expect month-on-month returns. In fact, between now and the next couple of months, you might see volatility in the markets. I don't think you should worry too much about that. If you do believe in the long-term story, that is India. And while that might sound like a catch-all kind of answer, let me tell you that we've gone through several periods like this when equities have sold off, and in the middle of the sell-off or after a sharp sell-off. So we are down, I think, about 9 or 10% from the last peaks that we had scored. These are the times when people stop believing in equities, and as it turns out, these are the times where sustainable bottoms are made, and then you see a tremendous lift off from here. I think there are global factors which are holding back people's confidence. There are local factors which are holding back people's confidence, and actually the fact that these factors are in the price tells me that some kind of bottom formation is happening. Can markets fall another 10% from here? Maybe they can. But if you have a reasonably diversified portfolio, you've taken long-term bets that you believe in, then maybe you will make a lot of money in equities if you start today.
Right. So taking clue from your last but one answer, so one of the investors is keen to know that if someone is willing to buy a mutual fund now, when should he buy? Is it should one wait for the third quarter results, or it will get another effect from the demonetization?
Okay, so that's a tough one, let me confess. We know that demonetization has happened in the third quarter. we know that, a whole lot of sectors, particularly those linked with discretionary consumption. So let's look at autos, let's look at real estate, let's look at cement, let's look at retail, particularly appliances. Let's look at the luxury car market, and so on. And we are seeing cracks in volume terms in all of them over November. And as you know, a lot of auto companies have shut down plants for not 1 week, but even 2 weeks for a few of them over December. And we are going to see softer numbers over November and December. We are going to see aggressive discounting play out as the new model cycle begins. And then we will see another round of discounting when we come closer to the budget. So yes, I think it's a fair question that it's not just for mutual funds. I think even for equities, if you do want to try and time the markets, and remember that timing doesn't always work. But yes, if you do want to take the risk of trying to time these markets, then perhaps waiting for the third quarter numbers is not such a bad idea.
Okay.
I think the best way to get over these humps is to be partly invested now and hold some ammunition for when the crack comes. So in mutual funds especially, there is this very simple thing which most investors think is not a particularly clever thing to do, but experience has told me that the best way to invest in mutual funds is to do it through systematic investment plans and put aside a little bit of money every month so that you actually average out. If you do rupee cost averaging, for example, then you buy more units of the mutual fund when the NAV cracks in a particular month. So the smartest answer to this tough question, I can tell you, is to actually step up the quantum of SIPs and not try and do lump sum investments into mutual funds. And when markets fall, hang on to those SIPs. Don't let them go. Now, make the right choices for the mutual funds that you want to invest in. We have regular updates and newsletters on mutual funds that we think are doing well and which are likely to do well. And I think the only way to overcome this kind of volatility over not a 1 week or 2 week or a 1 month period, but over several years of volatility, is to have SIPs in mutual funds.
Right. So the next question in line is exactly what you just mentioned, a little ahead of it. Whether lump sum or through the SIP route, should an investor look at index funds or mutual fund right now?
So I think I've answered that question on lump sum or SIPs. And most of us, we also do not have money which is just available to us for investing on a lump sum basis. Most of us who are investors are either running our own businesses, or we are salaried people who are saving a little bit of money from our salaries, or from, let's say, our upcoming bonuses in this coming year, or maybe some other sources of income. And we always have a little bit left over at the end of the month, depending on which month it is, of course, to invest in the markets. So actually taking a calculated call and constructing an SIP across 3 or 4 good mutual funds is the best possible thing for most of us to do.
Right.
For those who are completely out of the equity markets, there's always a start. So maybe you put about 20 or 30% of a lump sum today, or 50% of the lump sum in a mutual fund today, and then put a 5% kind of SIP over the next 10 months. So then you can consume your entire 100% of surplus funds if you have a lump sum. Now this is insofar as SIP and no SIP is concerned. Insofar as an index fund and an actively managed fund is concerned, I can tell you that the long-term returns from actively managed funds have always been, or usually been, in the case of many of the leading funds today, much higher than the index funds. That said, for people who have got no desire to beat the market and who are happy with market returns, and who don't want to see volatility with respect to market returns in terms of their underperformance or outperformance of their portfolios with respect to the market, if you are not sensitive about that, or rather if you're not really interested in outperforming markets, provided that you will underperform sometime, if you are an agnostic investor to that extent, then I think the cheapest way to remain in equities is to go through index funds, because I think most index funds charge you maybe about 50 bips a year versus more than 250 bips for many mutual funds. The 200 bips extra that you are paying in the case of actively managed mutual funds are in the hope that over a period of time, the particular fund manager who's managing these funds will deliver that alpha to you. Remember and keep in mind that sometimes even good fund managers, like cricketers, go through bad patches. And to write off a cricketer just because the last 1 or 2 years have been uninspiring is perhaps not fair, if you look at it in the light of maybe a 15 or 20-year outperformance that some of the fund managers of actively managed funds, and I will desist from taking names here, but several names of course come to mind. But if you look at some of these senior fund managers in our country, I think they've delivered way ahead of market returns over a decade and so on. And if they've gone through a couple of bad years, I think maybe they are on the verge of bouncing back. Maybe that's one way to look at it.
Right. So taking another clue from where we spoke on the sectoral picks. So specifically in the pharma bit.
Yeah.
So we have a question that Trump will be tightening the pharma space, the pricing regime specifically. Where does this lead the Indian pharma companies in terms of profit margins? With pharma companies priced to perfection. Sorry.
So in the first place, I don't think pharma companies are priced to perfection. I think there are lots of pharma companies where there are opportunities to grow which are not reflected in their current valuations. A lot of pharma companies from India have got incredibly thick or fat, or let's call them rich, US filing pipelines. There has been a fair amount of worry on regulatory headwinds for them. Every other day we hear of some or other company, Indian pharma company, which has been issued either a warning letter or a 483, or some inspection is going on and so on. So these are normal hazards and risks of running a pharma business. I believe that Trump's ascendancy to power in the United States and his views on managing healthcare costs actually directly translates into increased opportunities for generic companies based out of generic pharma companies based out of India who are filing for more and more drugs in the United States. The simple reason for that being that the largest chunk of pharma spends by the US population is actually on innovator drugs. Right. Typically, if you will notice, pricing for medicines which fall off the innovation or protection, or should I say patent protection regime in the United States, once they fall off patents, when drugs go generic, it is typically Indian companies or maybe Israeli companies and so on who are large suppliers of these medicines into the US, and prices actually crack by up to 90% or sometimes even more than 90%. Now, which country doesn't want that price cracks of 90% should be available to its consumers for drugs or for medicines which were till yesterday being sold for 100% prices and are now going to be available for 5, 6, 7, 8, 10 or 20% of their original prices. So if Trump is serious about managing healthcare costs, then all drugs which are going off patent between now and the next 2 or 3 or 5 years should see price cracks, and he will do his best to ensure that these filings or ANDAs which Indian pharma companies have made, the US FDA would be more than eager under a Trump regime to clear as many of these FDAs as possible, subject of course to their usually strict regulations and their standards and so on, which we completely respect. Right. So I think the case for Indian pharma companies to make more money between now and the next 5 years from the United States market and the opportunities there is tremendous. Not to forget the fact that the dollar is also pretty strong right now. So I don't, if you are a believer in what Trump says he's going to do, then you should be very strongly bullish on Indian pharma companies. Yes, they are facing regulatory headwinds right now, and a lot of them have been battered 10, 20, 30% from their peaks. So yet again, is this an opportunity? That's the question to ask.
The immediate question that investors have is, which are the picks that...
Yeah, so I wanted to know, Kavit, so I wanted to make this, I don't want to make stock specific comments here.
Right.
And I don't want to recommend individual stocks here, but still, I will just refer to a note that our institutional research desk had circulated as recently as Diwali, right. Which is maybe about a month and a half ago, and some of the pharma companies which we aggressively recommended there, and I can take names just because they happen to be in that list of companies that we had recommended. So, for example, we had recommended Alchem Labs. Which has got a very interesting and strong India business, but which has got a fat US pipeline of filings that I had spoken about, and it is available for less than 20x on FY18 numbers, and we had written a few lines on Alchem Labs in our recommendations during Diwali to our investors. And sure, the retail desk is more than free to share these recommendations with retail clients as well. Another company that we had recommended for similar reasons was Lupin. This is not to say that we don't see value in some of the other companies, or that I'm not actively recommending some of the other companies to my institutional clients. But I can tell you for sure that both on Lupin and Alchem, we have more than an ordinarily constructive stance, and there is no reason why you shouldn't share our research from the institutional desk with our retail clients on both these companies.
Definitely. The next one is on the GST bit. People are worried about taking from the last comment that when it is probable that GST could get implemented and how it will impact the Indian landscape.
Right. So the view on GST remains that it is a structural driver for improvement in macros in this country because of 2 or 3 reasons. One, it's going to simplify tax compliance. Now, I know that there are lots of complications, and frankly, even I don't understand some of the complications around GST and how it will work in real life in the day-to-day commerce that companies engage in. But I'm sure a lot of homework has been done. The general feedback that we are getting from, let's say, the KPMGs of the world and other consultants is that it is going to be much easier to comply with, one. Two, depending on the way the government classifies different kinds of manufactured articles within the GST framework, there is a strong chance that overall tax incidence on in some sectors may actually come down. 3, I believe that compliance having become easier and avoidance having become more difficult, I think a lot of the unorganized players. So, for example, I met the management of Exide recently, and God knows that 40%, I think, of the replacement battery market is through the unorganized sector, where tax compliance is much weaker than the organized sector.
Right.
So they foresee a lot of that competition to gradually wither over a period of time, as the burden of compliance on the unorganized sector is not going to be manageable. Another company that I don't mind naming is Jamna Auto, which makes leaf springs for trucks. And we know that, okay, so CVs are going through not such a great phase right now, particularly in the view of demonetization. But there too, the aftermarket has got a great percentage of that market is from the unorganized sector. So GST is going to lead to much more of the organized sector taking over market share. Now, tax compliance is going to improve. Overall tax incidence is going to come down. So the bullishness on GST driving up economic momentum in the country is unchanged compared to 6 months ago. However, we do see political hurdles, as can be seen from the recent noises and friction in Parliament. And if you ask me personally, I don't think that April 2017 will see a full-fledged rollout of GST. If it does happen, I will be more than happy, and I'm rooting for it to happen. I think the risks to that not happening have increased. September, or maybe sometime between April and September, if there is a feasible way to do this, is more likely. But sooner or later, GST is going to be part of the law of the land.
Right.
It's got a little postponed, hopefully not, but even if it has gotten postponed, I think the organized sector taking over some of the market share from unorganized sector in several spaces, not just auto ancillaries, is going to matter for investors. And the more we see this postponement, or the more we see near-term headwinds arising out of things like demonetization or global uncertainties, I think the opportunities to participate in the longer-term structural story will actually open up. So that's my view on GST.
Right. So taking again another clue from what you already answered, the coming union budget, will it bring any kind of relief to the equity investors? Any big scope that you see?
Right. So look at it from the government's perspective, and we need to outthink them here. And what are they looking at? They've injected what is clearly a very good shot of chemotherapy in the form of demonetization, and everybody is screaming at them for it. I'm not screaming at them, but almost everybody is screaming at them, and we are all talking daily about the kind of cracks that we are seeing in business and economic momentum. They need GST to be rolled out quickly. They want that people should believe in their story of constructing a right-leaning policy mix in this country. We have traditionally been left-leaning, and the quality of governance and transparency in government administration has been poor. They're working on all of these things, and now they need to take the Janta with them on this story, on this dream, and they've got 2 more budgets now. What do you think will happen? Isn't it obvious that they will unleash some kind of fiscal boost in this upcoming budget, which will make up, hopefully more than make up, but at least partly make up for all this short-term pain that is happening with the promise of long-term gain. So I think some short-term gain will also happen out of the budget. That's the obvious thing to bet on. And they've got the fiscal headroom to do it. Look at tax collections and where they've gone. Look at where planned spends are taking infrastructure in this country. Look at how let's say, for example, the pure play EPC road construction companies have seen a bloating up of order books. Right. Look at the possibility that auto companies might see over Jan, Feb, March once their sales numbers take off again. Look at the headroom that has been given to banks and microfinance companies and NBFCs to postpone the recognition of bad assets with a 60-day sort of additional headroom after the demonetization impact has sunk in. So I think we should look forward to the budget in terms of the budget unleashing fiscal boosts to many parts of the economy which have been slow to take off or which have suffered the brunt of demonetization, which howsoever it might look, howsoever good it might look in the long term, has admittedly caused short-term pains. I think if we go back to the analogy of looking at this, our economy as suffering from certain cancers, then this cancer patient is certainly going to get a lot of health food, apart from the chemotherapy that he or she has received in the near term. So that health food, that booster is definitely going to work wonders. Now, exactly what form it will take is something that only the finance minister and perhaps the prime minister will know. It is not for me to hazard that, but I think the broader direction on creating infrastructure, the broader direction on promoting rural consumption, the broader direction on increasing rural spend to protect the rural economy as it rides the benefit of a good kharif crop and perhaps an equally good rabi crop after 2 or 3 indifferent years on the monsoon. I think a lot of these positive factors are going to come together. Markets will anticipate them as they become more and more visible. So what should you be doing as an investor right now? Should you wait for the good news to come in before you buy, or should you buy in faith? I think that's the question that equity investors should look at.
Right. So the next question, sir, people are wanting to know your comment on the banking sector in specific for the next 2 quarters.
Yeah, so the next 2 quarters are going to be dicey. I can tell you that much. They're going to be dicey because I don't know how much of this headroom of the 60-day, forbearance that is being given for the NBFCs, for example, or even for banks for sub 1 crore loans. How much of that is going to be useful, because a lot of the delinquencies will get reported with a lag in the 4th quarter. So that could be one factor. On the positive side, falling interest rates are going to help the PSU banks much more than the private banks. So operationally and at the core, we love the business models of the private banks much more than we love the business models of the PSU banks. But remember that these very PSU banks, when they book treasury gains arising out of bond profits, bond trading profits, as you enter into the 4th quarter and beyond that. So you will see bond gains happening in the 3rd quarter as well as the 4th quarter. Many of these PSU banks will get opportunistic headroom to absorb some of their bad assets. I think better compliance in terms of recovering money from errant borrowers, and God knows there are so many of them, particularly on the corporate side, which are harming the balance sheets and which are completely damaging the NPA record particularly of PSU banks, but also some of the large private sector corporate heavy banks. I think a lot of this might also get cured as banks get the opportunity to use the headroom afforded by rising bond profits to book some of these losses, and better compliance in terms of recoverability of these bad loans. So you're seeing a lot of asset sales happening at many of the large corporates. So we've seen that happening at JP, and we'll see it happening in a whole lot of other groups, GMR, GVK, you name them. And as that happens, some of the losses, some of the bad assets on the books of the corporate heavy banks, whether the PSUs or the privates, will reverse, and you might see some benefits happening there. On the flip side, I believe that again, credit growth is going to be challenged in this environment. So some of the numbers, especially for the fast growing companies, let's say the NBFCs which were growing at 20, 30, 40%.
Right.
So, and you are seeing it reflected in companies like Bajaj Finance. We don't have them under coverage, I must add. But so some of the expectations and valuations around these companies have already reversed. But maybe some of them offer great opportunities as they recover out of these blues over a period of time. So I think the news is going to be mixed for financials between now and let's say March 2017. And for diligent investors, for diligent fund managers, this is going to open up opportunities to invest in them. I do not think so. There was a time when we were not having too many hopes on PSU banks, given the constant increase in slippages that they were reporting, particularly around the AQR exercise. But you looked at what happened to Axis Bank last quarter and they got punished for it. So I think even in the private sector banks, there are going to be banks which are going to offer you opportunities to invest. It's not that they are going to move one way. They did move relative to the PSU banks for a long time. But I think between now and March or April, I think both parts of the financials on the banking space are going to give you opportunities to invest.
Would you like to take any specific name in the banking sector?
So I have said that I don't want to take specific names, but again, if I go back to my Diwali picks and if you look at this list over here, so from the private banking space, I can immediately name three names: two small banks and one large bank, where we have a lot of hope. And again, this is not hope and not bullishness that is based on 1 quarter. With a 1 quarter view of stock performance, or even with a 1 year view. To tell you frankly, we have a 2 year view, at least a 2 year view on most of these stocks.
Right.
So if you look at the small private sector bank space, then we are more than constructive on both City Union Bank and DCB. And in the private sector space, we have a very, very high opinion of Kotak, which has, by the way, corrected recently,
Right.
and which we believe offers long-term investors an opportunity at this price.
So the next one is the budget focus and government policies include Awas Yojana, rural roads and electrification.
Yes.
What are the specific areas that you think these will benefit?
So if rural infrastructure construction takes off, in fact even if the national highways network continues to see the kind of investing and tendering that we are seeing from the Ministry of Road Transport and Highways or NHAI, then there are several companies which will benefit from infra spend in rural areas. I think apart from the infra spend in rural areas, keep in mind that MSPs have also seen a tweaking which is more than the tweaking that we've seen in the first 1 or 2 years of this government. So rural consumption is also going to take off. If demonetization has knocked the wind off the sails of, let's say, appliances companies, I think this is a very good time to look at some of them. This is a very good time to reconsider investing in high quality EPC players like say a KNR Constructions, for example. And I'm taking stock specific names here, and I'm not afraid. I'm not shying away to do that. I think renewable spends can can drive companies like Inox, notwithstanding the near-term headwinds in their business. I think power transmission spend can drive companies like Kalpataru, for example. Transmission and distribution infrastructure upgrades will certainly matter for both Kalpataru as well as for Techno Electric, for KC. So there's a whole lot of proxies there, and I think Atul Auto has taken a hit recently, and it is also likely to benefit as three-wheeler sales pick up. So there's a whole lot of proxies, and if you go back to my Diwali list, you will find all of them there.
Sure, sir. So one bigger question
Yes.
is looking at demonetization, looking at Fed hike rates, looking at other global events, and also looking at the coming budget, GST rollout, etc. How all of this will, in a nutshell, what is the kind of impact that it will have on the investing cycle?
Right. So it is true that there are some positives, some negatives as we move into 2017. My personal experience of investing in markets, and I remain humble about my experiences, but my limited experience has taught me that when things are not so clear is typically the time when equity valuations take a hit. I must also confess that valuations right now are not absolutely bargain basement. The risk of downgrades in earnings estimates is also real. So valuations can actually, implied valuations can rise from moderate to slightly more than moderate levels right now. But the fact is that India is changing. India is changing in ways that it has never changed before. So higher tax compliance, can you believe it that in a country of more than 1250 million, you have less than 30 million personal taxpayers, or some such number, maybe 30-35 million.
Right.
So I think that is going to change. Demonetization, one of the objectives of demonetization was to improve direct tax compliance, and you can see it happening in the disclosure schemes, the income disclosure schemes before and after demonetization also. So that is one large lever that the government is moving. The second big thing about India was that interest rates were unreasonably high, and that led to limited opportunities for equity investors to make money. Remember that earnings yield is correlated with your system interest rates in the economy, and as interest rates in the economy fall, earnings yield will tend to chase that fall, which means that PEs should rise.
Right.
Okay, I do agree that the world is in turmoil, but I think India is the only large economy in the world, and by large I mean $1 trillion or higher, which is growing arguably at somewhere around 7%, and on a path which promises to take it close to double digits, if not 10%, then at least 8 or 9% over the next 1 or 2 years. There are challenges in this path. There are internal challenges, there are global challenges. So oil prices can play truant. We can have political unrest in the world. Europe, the pains in Europe can show up. Japan is in a moribund state right now. High oil prices meant that we had a large expat population in the Gulf which was remitting a lot of money, and that has changed a bit now. Maybe the United States and its open economy will not remain so open as Trump's ascendancy materializes in January. But I do believe that the quality of governance in this country, the quality of tax compliance, the ease of doing business, and the increased infrastructure spend, the increased recognition that Bharat has to also be looked after, not just India. And this recognition has happened over a period of time with this government, and I see a lot of confluence. I see a confluence of a lot of positives, and some of the negatives that we see will be ably countered. We have some of the most talented people in the world, and you can see Indians achieving such a lot when they go to countries like the United States or the UK and so on. Right. I think it's time that Indians do well in India. India is going to be a better managed economy. It's going to be a better managed government over the next few years. And to that extent, I think the opportunities for making money in equities are probably the best that they have been in a long, long time.
While we are seeing conclusion of 2016, and the obvious and probably the every second question on the board is just revolving around two things. How should one invest in the next year, and which are the specific stocks that you would like to name, at least few of them? So
I've spoken about a lot of stocks today,
right,
and I will desist from that temptation anymore. No, but how to invest in 2017? So let me tell you, how to invest in 1917 was the same as how to invest in 2017. How to invest in 2014, 15, 16, 17, the mantras are the same. And for all of you clients of HDFC Securities out there, I have 2 or 3 top level pieces of advice to share with you. So if you are somebody who likes to, who thinks that you want to devote at least a couple of hours to markets every day and trade the markets, there is a specific set of products that HDFC Securities gives you there. So we give you F&O advisory, we give you day trade ideas, and a whole lot of other things which are driven partly by technicals, partly by fundamentals. I think Deepak's team shares what are known as techno-funda ideas. Right. We have picks of the week. So a whole lot of short-term investing is possible to do there. If you think that is not your cup of tea and you want to invest for the long term, then we have a list of DIY SIP stocks which the retail desk shares from time to time. We also have high conviction large cap picks that the institutional desk publishes from time to time. The last one we published has been on GAIL, for example. We published as recently as yesterday on GAIL, where we've laid out the thesis for the next 2 years for this company. So if you want to buy large cap stocks, and do DIY SIPs there, then if you're that kind of investor, so that's the product or that's the investing style or strategy for you. If you want to take calculated risks in mid caps, then we have a whole list of mid caps where we have conviction ideas, and some of these mid caps are often discussed in the pick of the week window by the retail team. And if you want to constantly monitor them and trade out when you make 20-30% gains, that's one way of doing it. If you want to hold on for the long term, then there are several mid caps which have given multi-bagger returns. My memory takes me back to companies like ITD Cementation or Sanghi Industries, which were unheard of when we first had coverage on them. Naveen Fluorine also comes to mind. The institutional desk has been pushing that for a while, and outsized returns have been made there. I must say that the retail team has also been more than agile in publishing plenty of these ideas. So if you want to invest with a deep value perspective, then you have a certain set of strategies where you can get your RMs or advisors to get you to invest there. If you really want to say that, no, I don't want to monitor markets on a day-to-day basis or even week-to-week basis, then I'm a working professional. I need to put my time to good use while my money works as hard as me. Then I think mutual funds are the way for you to do this. Particularly mutual fund mein DIY SIPs. If you don't want to pay high fees to fund managers, then and you have a constructive view on Indian equities for the long term, then you should be investing in index funds. Right. So there's a whole lot of different strategies, and let me tell you, Kavit, these strategies do not change year on year. These approaches to investing should not change year on year. So my mantra for 2017 is the same as what it used to be for 2012, 13, 14, 15, or 16. Maybe I think that should be a good way to close the webinar, unless you have more questions.
Oh, Dipen, thank you so much. And a lot of investors would have got a lot of clarity in terms of the investing patterns, what all different events have made impact on various sectors, various stocks, how should they be investing, whether different routes of investing, mode of investing, etc. So I hope with this, Mr. Sheth has given a lot of clarity to us.
Thank you. Thank you for inviting me.
Thank you so much, sir.
Thank you for inviting.
Thank you so much.